general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening and welcome to Your Money, Your Call. I'm Chris Kimber. Tonight I'm talking shares with Roger Montgomery of rogermontgomery.com and Ben Clark from TMS Capital. If you've got a question about shares, our phone lines are open right now on 1300 30 34 35, or if you prefer you can email us on yourmoney@skynews.com.au. Welcome to the program. Well, 2 days in a row, up 1%, 40 points yesterday, up another 40 points today, up over 2% in 2 days. Germans having a great time with confidence soaring over there and their export markets doing very, very well. Italian bonds yields dropped down below 5%, so it looks like the Italians and the Spanish are no longer worried about any fallout from Greece. Greece has become the lone domino. Even if it falls, it'll be falling by itself, it looks like. So has Europe become yesterday's story? Good news out of the US. The economy there looks to be picking up. And China still chugging along at 8.5%, as we've talked about for the last year or so. That's, Ben just said it himself, but you know, we were on a couple of weeks ago and Ben was bullish and you sort of, I think, were nearly going to go fully invested. I think we're talking about. What have you been doing the last couple of weeks?
Well, what viewers don't know is that after the show's over, the three of us go and talk in the car park about the stocks we really like.
We can talk about those later in the show.
If someone happens to call up and ask about them.
They have to be investment grade though.
Yeah, that's right. That's right. And so we have all been fairly bullish.
Yeah.
And that's obviously been right. In addition, I think what we've still got that isn't solved in Europe is a solvency issue. There is still a solvency issue. Ireland now and Italy and Portugal and Spain will look at the deal that Greece has done and they'll say, well, why are we struggling with budget deficits and struggling with these giant interest payments? Let's renegotiate our debt. Yeah. So I think short term, I'm much more comfortable as we were 2 weeks ago. Yep. And I don't think, I can't see anything on the horizon that's going to stop that in the short term. But long term, I think there are still major issues, yep, fundamental issues. Now, the caveat to that is this, that in the 1930s, in 1932, the market bottomed and it started to rally in 1932. There was still 8 years of depression. Yep. It was the worst period for the world, in terms of the economy. And the market bottomed. Yes. 8 years before it ended. Yeah. So you've got to bear that in mind. We might be, Greece is 5 years into a recession. The United States is 10 years down the track. It's already had one lost decade. We'll probably get another lost decade. Yeah. Then there's still an issue with Japan. We're at an inflection point in Japan now, yeah, where the savers are pulling out. The government's been able to borrow money at very cheap rates for a very long time because the Japanese are such great savers. But now they're dissaving. They're ageing and they're starting to pull money out. So Japan could be the next problem. Yep. I don't know where the next problem is going to come from, but while the money's going into the economy, into the markets, and it is going to the markets, and we talked about, Ben just mentioned the JP Morgan's buyback, that's where the money's going. Yes. You've got these zombie banks that shouldn't have survived. Yeah. They should have been allowed to go broke. They should have been allowed to write off their debts. But they weren't allowed to do that, and it would have been a very painful experience had that happened for the world. Yeah. But they haven't been allowed to do it. So now all this quantitative easing, the money's not going into the economy. It's not going into the economy in Europe. It isn't going into the economy in the United States. It's going into bank coffers, and they're using it to buy back their shares, driving up asset prices. Yes, well, the investment bankers needed their bonuses. They wouldn't, had taken a haircut, it wouldn't have worked. All right, thanks for that, boys. Good start. We've got Rhonda on the line from Sydney. Hi, Rhonda. What's your question for us?
Hi, Kim. I would like to ask the panel, how is BHP and Rio going to do in the next 2 months, and when is a good entry point, please?
Yeah, listen, thanks very much for your question, Rhonda. Look, the last week's been very interesting in BHP and Rio. I found it quite entertaining to find several major investment houses cut Rio from their portfolio at $62 the other day and downweight their BHP on some sort of a long-term problem with their business plan just before BHP rallied $2 and Rio rallied $5 or something like that. Look, I'm still very happy that BHP and Rio are cheap where they are. You know, whether you think Rio's going to 100, but I still think there's 20 or 30% in it, and I still think BHP is worth somewhere north of $40. So I'm sort of still think they're pretty cheap where they are. What do you think, Roger?
We've thought it was cheap for a while. It's trading right on its intrinsic value now. Both Rio and BHP, both of them are. I've always said on this program that BHP is the better of the two in terms of all of its metrics. Its working capital, its balance sheet, return on equity, all of those things are superior at BHP than they are at Rio. So it's always been my preferred of the two. But you can't invest in these businesses looking in the rearview mirror. You absolutely have to look forward. And the key driver is the iron ore price. And we've seen iron ore come from $170 a tonne to $142 a tonne today, I think, about 142. About right, I think we're going to have, you know, I was sitting at my desk this week and I laid out all of the expectations for iron ore production for all of these companies, and their share prices have rallied because of the expectations for higher production. But when you aggregate them, you think, well, what's this supply response mean for prices? Generally, it means lower prices. So if we expect that we're going to have lower prices in the next couple of years, and I certainly think we will, then there's two ways to think about it. One is that you'll get a big you'll get the supply response, you get lower prices, but more volume going through. And more volume going through, obviously, that means they'll still make the same amount of money, but they'll be complaining the way Jerry Harvey complains about having to sell as many he's got to sell more plasma tellers at the lower price to make the same amount of money. You know, he complains, and there's margin compression. The other argument is, well, Roger, if this is what I'm having conversations with this week, with people about this week, and that is that it costs Australia about $30 a tonne to get iron ore out of the ground, give or take. Costs China $130 a tonne to get out of the ground. So if the price goes down, it becomes cheaper for them to import our iron ore than to produce their own. I'm not convinced. I'm not at all convinced that it's in China's interest to buy more from us if it's too expensive for them. So I'm just not convinced about that. But nevertheless, margin compression, and I think you'll get some bearish sentiment coming in even further, more than what we've got.
Are you happy to own them?
No, we don't own them.
Don't own them. Okay, no worries. Thanks very much. Doug from Young. Hi, how can we help you?
Yes, g'day gentlemen, and thanks for taking my call. Dominoes Pizza is my query tonight, mainly because every time I do the figures I come up with the valuations way below the current share price, and yet the share price keeps going up. So I'm wondering if I'm missing something, if there's some great growth there that I haven't factored in, or whether the price in fact has run ahead of itself. Listen, your opinion's valued.
Thank you very much for your question, Doug. It's quite funny you brought this up because we were just discussing this when we were standing outside before. Because I've never owned Domino's Pizza and I've never eaten a Domino's Pizza, so I actually...
You're not the target market,
I'm obviously not the target market, but I've missed out, and every time I've looked at their reports, there doesn't seem to be any cost in there for food. There's plenty for rent and plenty for staff, but there doesn't seem to be any food expenditure. So anyway, Roger, what do you think?
I'll start. So Doug, the numbers that came out, for the recent results were spectacular. On every measure, the results were absolutely phenomenal. What you have to understand is that analysts in Australia have long been saying that Domino's is ex-growth. You've got to understand also that they're the biggest franchisee of the Domino's brand in the world. They've got 848 stores around the world, including France. Now, it might surprise you, France, with all their very fancy food, are the second biggest per capita consumers of pizza per head after the United States. And they're growing in France, they're growing in the Netherlands, classic numbers, massive same-store sales growth in Australia. They raise the price and they've got a competitive advantage, and this is classic evidence. They raise the price every year for their pizzas and they make their pizzas smaller. Well, that's how they save money. That's how they save money on the food, on the inputs, because they're making the pizza slightly smaller every time and keeping the price the same or charging more. They've also signed a contract that was just announced this week or last week that they're going to move to electric scooters to deliver the pizzas to save money on fuel as well.
My guy turned up on an electric scooter.
Did he really?
Yeah.
There you go. This is the thing. Every analyst in Australia has been saying the same thing for a very long time, and yet same-store sales growth goes up. You know, it was 8.5% or something in the recent results, on top of a 9.5% growth last time.
So will you buy it now?
No, it's very expensive.
It's expensive.
Yeah, it's trading on. I mean, it's trading on over 20 times.
Right, there you go. And I think that might be the answer. I think stock's expensive, and probably the other lesson is don't go there on Monday nights, according to Mr. Clark. Very expensive on Monday nights. We're going to fit in a quick email. This is from Bill from Kingscliff. He bought Myers at the start of the year for $1.95. Today's close was $2.37. Is it worth staying in at this entry price, or would you take the profit and invest somewhere else?
Look, I wouldn't buy Myer.
Yep.
Myer is a business that really is going to struggle as the structural shift in retail continues, and we see more online. We see more. We see the high end going really well. So the luxury goods providers are doing really well. The bargain basement guys are doing really well, and in between, everyone seems to be heading online. Myer isn't doing such a great job of that just yet. Unfortunately, however, in Australia, fund managers don't have many choices to buy things. They don't have many companies that they can buy that are sufficiently liquid, and there's been a sectoral shift or a cyclical shift away from resource companies and into some of the industrial businesses and retailers. It may be early, I don't know. So you've done very well buying Myer because you've caught that wave, and $1.96 is my estimate of its intrinsic value, so you've bought right on its intrinsic value as well. I think you got lucky. The boys don't agree with me. I think you got lucky, and if it keeps going up, you'll be even luckier. But look, there are better retailers out there. Oriton's a classic example. I think some of the online businesses like Seek, car sales, they're better retail type businesses with brighter prospects.
I can't believe you didn't use the catch a wave and segue into Billabong, Roger, but that was pretty good. Time for a quick break. Welcome back to the program. Tonight I'm joined by Roger Montgomery of rogermontgomery.com and Ben Clark from TMS Capital. If you've got a question you'd like us to answer, please call on 1300 30 34 35 or email at yourmoney@skynews.com.au. Anthony from Melbourne, thanks for waiting over the break. How can we help you?
Yeah, thanks guys, love the show. Just want to get a technical and fundamental analysis on Range Resources.
Range Resources, thanks very much for your question, Anthony. Look, I think we're going to probably struggle on Range. I have a feeling Range is a speculative mining stock in Puntland. Is actually the country it's in. At a guess, I'm not exactly sure, but I think I seem to remember this stock going for a very big run about a year or two ago on a wildly inaccurate report about the mineral wealth of the country, and how. Yeah. Hydrocarbon exploration in Somalia. Somalia, is it? Well, there you go. I think it's, Somalia, Puntland, where the pirates are. So my first answer is that I just don't like risking my money in something that might get taken over by the locals or a pirate.
There are some forecasts, perhaps surprisingly, there are some forecasts for 1 cent of earnings per share for 2013. And 2 cents earnings per share for 2014. And if it hits those numbers, then theoretically the valuation of the company is 2 cents and 14 cents. And it's currently trading at 19 cents. So you've got to wait 2 years for the intrinsic value to catch up with the current price. But boy, oh boy, hydrocarbon exploration in Somalia. I'd rather try selling surfwear in Sydney. That'd be easier.
I think that's fair enough. I think we might avoid Somalia. Sorry about that, Anthony. But we might go straight to Eric from Sydney. Hi, Eric. What's your question for us?
Thanks, Chris. I heard your little jingle about the gloom and doom merger. So I was in Europe from the 20th to the 10th of March, and I can tell you from my perspective, people are spending. As I was away, Ben, on the IRESS result, if you could possibly go through the IRESS result for me. Thanks a lot, mate. Bye.
Great. Thanks very much for your question, Eric, and good to hear that good news of a bit of spend, Roger.
Oh, look, let me tell you, I agree with some of what Ben has said, and I just wanted to add to that I think the analysts are looking at it far too closely. When analysts get bored, they start playing with their navels a bit, and they're talking about the FOFA reforms in financial services, meaning that lots of financial planners are leaving, so their ex-plan business, is under pressure. We heard brokers being laid off. That means, of course, that we're going to end up with fewer people using IRESS terminals. But what this company has done, what it's succeeded in doing, is it's entrenched itself in the lives of financial planners, and it's entrenched itself in the lives of stockbrokers. Yeah. So I can't set up a funds management business in Australia without having an IRESS screen and electronically settling all my trades. And it's all done through IRESS. Yeah. So, so they've integrated themselves into our lives, and we can't do without them. The result is that they've got no debt, 40+% returns on equity, which is a classic indication of a competitive advantage. I think it's expensive, but I agree with Ben, like Computershare, it's leveraged to a recovery in the stock market. And if you get a recovery in the stock market that's sustained, and that's the key, if it's sustained, then eventually you'll see these companies catch up.
Fair enough. Thanks for that, boys. We'll go to Selwyn from Perth. Hi, Selwyn, and what's your question for us tonight?
Yes, I'd like to ask Roger with regards to a stock called Acrux, ACR. Is the stock undervalued at the moment?
Okay, thanks very much. Acrux, ACR is the code. Acrux, I don't know, is it oil and gas?
No.
No?
Hormones.
Don't know that one.
Hormones.
Hormones, well, there you go. Much better.
Hormones through the skin.
There you go, I wasn't even close.
We've looked at this, there was some corporate activity around this stock last year. There were a lot of disgruntled shareholders who weren't happy with the decision that the board had actually made at the time. But I actually don't think that this particular business is particularly cheap at the moment. I think its intrinsic value for 2013, based on current analyst estimates, is about $2.86, but it's trading at $3.75. So I actually think it's a bit expensive.
All right, no worries. Thanks for that, Roger. We've got Dean from Darwin. Hi, Dean. What's your question for us tonight?
Yeah, g'day. Thanks for taking my call. I'm just interested on where you think Haranga Resources is going. I brought them a little while ago at 20 cents, and they've moved up a fair bit in the last few months.
No worries, Haranga. Is it what sort of metal is it? And are they in Australia?
Or in Mongolia, and they're looking to transport to rail to China.
Okay, are they coal or iron ore or copper or what sort of metal are they involved with? Or
iron ore.
Iron ore, are they? Great, thanks very much.
Now,
thanks.
Dean, they're not making a profit, are they? They're
not at the moment.
No, they're not. Have you got some insight into whether or not that's going to happen and when?
They believe the first production will be within 12 months.
12 months, so there's another iron ore producer who's coming online in 12 months.
In Mongolia.
Look, mate, it's hard for me to value a business that isn't making a profit, one that doesn't have a track record. There's no analyst estimates on it either, so it's not one that I can actually value for you. What we often find is that companies in this space rally in anticipation of production, and then when production actually occurs, they often that rally's gone way ahead of the justifiable value, and you see it pull back. We saw that with Fortescue as well. So just be careful of that, and make sure that you're very disciplined in your profit take.
Right, good stuff.
And just one last comment. Yep. Dean called in, and he's made a profit on his stock. We've got to remember Fortescue rallied from 26 cents to over $12, almost $13. Yep. And it was $13 back in 2008. It's never got anywhere near that since. Yeah. So you've got to remember that there's a lot of enthusiasm around the imminent production profiles of these companies. But once the reality hits, people can start to value them properly. Yeah. Look, my valuation on this is higher than the share price. Oh, okay. But again, it's dependent on that iron ore price.
All right, good stuff. Thanks for that, boys. I'm going to sneak in another email now. We're going to go from Ken, this one is. Could the panel give me their opinion on King Rose Mining? It's a gold stock that looks cheap based on current fundamentals.
Roger,
gold in general and that one? Yep.
At Montgomery Investment Management, we sat down, we went through every gold stock. Yep. We went through them with a fine-tooth comb. We came up with Troy. Yep. We came up with Silver Lake Resources, and we came up with Red 5, and we passed on this one. Yep. It's based on estimates for this year and next year. It looks cheap, but when you go out to 2014, what you find is the intrinsic value drops significantly, and it's trading at about that value.
Welcome back, and thanks for joining us. I'm Chris Kimber, and with me tonight is Roger Montgomery of rogermontgomery.com and Ben Clark from TMS Capital. We're answering all of your questions on shares this evening. If you'd like to get in the conversation, please call on 1300 30 34 35 or email us at yourmoney@skynnews.com.au. Nathan from Wollongong, thanks for waiting on for us. What's your question?
My question for the guys tonight is on QBE. I'm a currently disappointed QBE investor. The question is, with the new share purchase plan, what do they think
Yeah, listen, thanks very much for your question, Nathan. Look, QBE's rallied pretty strongly in the last few days since they raised, I think, whatever it was, $500 million at $10.75 without the dividend recently. Look, fat profits, we actually bought some QBE before the placement, unfortunately, a bit higher in sort of the mid-$11 sort of price range, expecting a rally. I'm still not a big fan. I don't own any.
I think you need to stand back and you need to realise that there's a, if you like, a super cycle in premiums, and what's been happening is because of the cheap credit that's been floating around the world since 2007, 2008, really, what's happened is that's done a couple of things to their profits. One, it's brought down bond rates. Now, 90% of their portfolio, 80% of their portfolio is at 90% in bonds, and at a large, and they've got to own bonds in the countries where they insure. So the interest rates there are very, very low, particularly the United States. So if you thought there was a bubble in US Treasuries and that it was going to pop, then these guys start making more money on the bond portfolio. Having said that, though, there's a super cycle in premiums, and premiums have been coming down for a very long time because of that cheap credit. Yeah. Right. So you've got free money, easy money. So everyone competes to offer insurance, and premiums come down. But eventually, those premiums stop coming down. They start going up. What concerns me is that the reinsurance rates, particularly around Asia and New Zealand and Australia, for example, reinsurance rates have gone up, and so, because reinsurance rates are so high, I read one of in the report, I read that they've pulled out of some of that business. That's a little bit like the trader who has 3 losses in a row and gives up, and the next trade is going to be the profitable trade, Yes, and they've given up early, and that worries me a little bit, that they won't get as big a kick as they would have got if they have the quiet year that Ben was talking about. Yeah. But boy, oh boy, if you talk to some of these climate doom and gloomers, that we're not going to have a quieter climate profile, and that could be difficult. Having said all of that, this is the cheapest it's been since, 2004, and it's right on our estimate of its intrinsic value now. Okay, good stuff. Thanks for that, boys. We'll go to Michael from Sydney. Hi, what's your question for us?
Hi, so I'd just like to ask the panel a question. I've got a small sum of money that I've now managed to get hold of, and I've been looking to buy 3 shares, and I was looking to see what the panel's view on possibly three recommendations based on shares that are selling under the intrinsic values at the moment.
Right. We'd want Michael to buy the ones that we own.
That's exactly.
So what have you got the biggest position in?
It's always a difficult question, Michael, because it depends, a lot about your personal situation, what you want to do. Is it long term? I mean, there's a whole series of questions. But I mean, look,
I'll run through a list.
Anything listed, can leap off the top of your mouth.
Michael, I like Credit Corp for reasons I'll explain shortly. I like Breville Group, and I like MTU, and I also like, I'll give you a fourth one, Seek. These aren't companies for you to go and buy, but they're companies for you to go and research and investigate and collect as much information about as you can. We own all 4 of those companies, so bear in mind, if you go and rush out and buy them, you're helping me more than yourself. And I might turn around and be a seller if you push it up too far, Michael, so just keep that in mind. But in all seriousness, we own these stocks. We've invested a serious amount of money in them, and at the moment we like them.
Excellent. Okay, thanks very much. The only one I'd add in there, because we're sticking basically the top end of the market, is New Hope Coal. Sol Patts owns about 59% of it, and recently they cancelled their sale process. They were looking for $7.50 for the stock. Very good yield play, back down around the 540s at the moment. I think you can put that away. Reminds me of MacArthur Coal when their takeover deal got cancelled. It ended up happening at some stage. We'll go to Joanna from Victoria. Hi, Joanna. How can we help you?
Hello. Thank you, guys, for taking my call. Yeah. I just want to know how Westpac convertible shares and what you think of them. Yeah. Should I invest?
Great. Thanks very much for your question, Joanna. Look, I'll start off with that. Westpac convertible notes is one of 487 different fixed interest issues that have come out over the last 2 or 3 months, a lot of which are trading underwater, and a lot of which aren't as good quality as some of the ones that are already listed.
They replaced.
That's right. So quite often you've had people selling quality ones that are listed and then take up the new ones simply because Westpac or ANZ or Woolworths or Colonial or
their broker told them they should.
Or their broker told them that they should sell it and then switch into this one. We're not participating in this Westpac deal. I think there's a lot of other things you can do with your money, like buy Telstra that Ben just suggested that you're going to get a far better yield out of. Fair enough. Now, like Roger, a lot of people think these things are risk-free, and they're not.
Well, I can tell you from personal experience that, I remember in the GFC buying some of these preference shares and hybrids that were issued at $100 and buying them for $30, $20, $17, buying them on 30-40% yields. They trade remarkably like shares when it hits the fan. So when the market volatility picks up, what you'll find is that they'll trade remarkably like shares, and they won't be that smooth, steady term deposit behaviour that you're expecting from them. So just be very, very careful. I also prefer to only buy preference shares if I can buy the stock at a discount to its intrinsic value, and Westpac is trading right on its intrinsic value. It's not cheap enough for me. ANZ is the cheapest of the banks, so I won't be participating.
Excellent. Great. Thanks for that, boys. It was time for a quick break, but before that, it's time to start the stock watch yet again. And we're going to go to Roger to find out what he is watching, and his time starts now.
Times I've been on this spot, I've mentioned the same stock, and this time's going to be no different. I like a company called Credit Corp. Its results came out and they were absolutely spectacular. It's the best of breed. It's got 9.5% debt on its balance sheet, so it's got plenty of room to expand its debt ledger purchases. It's got the highest return on equity. It is a great company and it's doing very, very well. Always exceeds expectations, and it's cheaper than its intrinsic value.
Perfect. And in time. Well done. Welcome back to the program. Joining us in the studio tonight are Roger Montgomery from rogermontgomery.com and Ben Clark from TMS Capital. If you'd like to get in the conversation, please call 1300 30 34 35 or email us at yourmoney@skynews.com.au. Ian from Sydney, thanks for waiting on. What's your question for us? Ian, you still there?
Roger, his value on Matrix.
Matrix, yeah, listen, thanks very much.
The stock he used to follow.
Yeah, excellent. Thanks very much for your question, Ian. Yep, Matrix has started to pick up a bit lately, Roger. What do you think?
Well, I think it's picking up in anticipation of an order, but there hasn't been one announced. So, Ian, we've been talking about Matrix Composites and Engineering here on the show for quite some time, almost 2 years. We first liked it when it was at $3 and it rallied all the way to $9, but when the first half 2011 results came out, the cash flow started to deteriorate. So I sold my holdings around the $7.40 mark. The outlook for this company I don't think is very good at the moment. I think the issue is orders. Where are the orders? There's been a turn up in activity in terms of offshore oil exploration, and that's a good thing, and that's good for their riser buoyancy orders. However, we're not seeing any orders being announced to the market. We actually had a meeting with one of our brokers and their research analyst who covers this particular space this week, and we asked them to put one question into some contacts they have at Chevron. We asked them to find out why they haven't been giving their orders to Matrix Composites and Engineering. Once we've got an answer to that question, I'll share it with you. But before then, I'm not interested in buying the stock because I actually think a company that makes a loss is worth zero.
Yeah. All right, thanks very much for that, Roger. We'll go to Kerry from the Gold Coast. Hi, Kerry, what's your question for us?
Yeah, panel, how are you going?
Good, thank you.
Caltex, CTX.
Yeah.
Probably more of a chart. Once it breaks $14, a very bullish chart. I guess we're waiting for Caltex to come out and say they're going to close refineries in Australia, and this stock's going to, motor pretty well. I think everyone else got $18, $19 on it, written all over it.
Yep.
They've got $1 billion of franking credits, which is my interest because they've really stressed they're going to return that to shareholders in some form.
Yep.
But yeah, just thoughts on Caltex. Thanks, boys.
Yeah, listen, Kerry, thanks very much for your question. Look, I know that there are 2 or 3 other brokers that agree with you. They like Caltex. I think valuation's up. I think I saw 1650, might have been the most recent one that I saw. It's not the oil, it's not the stock that I'm in. Santos has performed very well, and I think at some stage Woodside will sort out the overhang from Shell, and that'll prove to be quite cheap. Quick one. Yep.
I agree entirely with that. I stand back and I like to buy businesses that are substantially larger in 10 years than they are today.
Yeah.
I like a business that's going to grow. And I like it's going to grow its intrinsic values materially, and I can buy it at a discount to that intrinsic value. That's my hope.
Yep.
And when everything lines up, we buy stock. This is a company that in 2014, even if you take into account a sale of the refinery business, is going to earn less than it was earning in 2004. just for me, I'm just not interested. Yeah. You may make some money out of it on a blip, you know, as the share price rallies, but if it doesn't generate a return or an economic return that justifies that rally in the price, then the price comes back again, and that's what we've seen to date. I think that might change a little bit. Well, it actually will change if they get rid of the refinery business, because that Singapore refiners margin, you know, put your finger in the wind and try and guess what that's going to be. I think that is an improvement, but the business needs to generate a lot more money. Not just be a slightly different business. It needs to generate a lot more money and be bigger in 5 years' time than it is today, and I'm not sure that it can be.
Can't see that. All right, no worries. Thanks for that. We've got Greg from Melbourne. Hi, Greg. What's your question for us?
Good evening, Chris, and thank you for taking my call, and good evening to Ben and Roger. Chris, my question to the gentleman tonight is about Graincorp. In the last couple of days, of course, it's come to the market that the great large Glencore has made a takeover bid for Viterra from Canada, and I was just wondering what the two gentlemen thought of to invest in Graincorp. Unfortunately, it's gone up quite a bit in the last couple of days, so I was just wondering whether the two gentlemen think of investing in this stock at the moment since it's gone up. Thank you.
Thanks very much for your question, Greg. Look, Fat Profits has Graincorp in their portfolio, in one of our portfolios. We like the stock. We obviously didn't know that Glencore was going to bid for Viterra, but thanks very much for, you know, kicking the stock up there.
Look, the theme that's driving sentiment around these stocks is, you've heard the peak oil argument. Well, there's peak rice, peak corn, peak wheat, peak everything. Yes. You know, and I think there was an analyst in the United States who came out with a report last year and basically just, I think the title of the report was peak everything. Yes. You know, the idea of a food crisis is very real. Yes. And you know, bad weather, we were talking about QBE earlier, you know, but bad weather only makes it even more difficult to supply the growing global population with food. I don't understand that, because I see so much food being wasted. You know, thousands of tonnes a year is being thrown out at the other end. So having said that, that's the theme that's driving the consolidation in this particular space. But the rally that we've seen in prices, and the problem with that chart that we saw a minute ago, was it's very short. The rally today and yesterday has only just taken the price to where it was in 2002. It's gone sideways. It's just been range bound the whole time, and that's because the business isn't worth as much as where it's trading. And in fact, over the next 3 years, as a going concern, assuming there was no takeover, as a going concern, intrinsic value actually declined substantially. So I wouldn't be participating in this unless I was very, very confident there was going to be a takeover.
All right, excellent. Listen, I just want to fit, you know, we get heaps of emails. I'm sorry we can't get to them all, but I want to fit a handful of stocks in. Roger, one of your stocks had a cracker result when we were on a couple of weeks ago. Up again today, 6.15%. I think it closed up over $7. Seek. What's the story?
Look, we like this particular company very, very much. We think operationally it's just doing a fantastic job. It's the number one. It owns a share of the number 1 or 2 like player in most of the major economies that it's operating in, except for China. However, there's a report going around at the moment that the Chinese business is going to be listed, and it might be listed at $100 billion or something like that, and they own a substantial proportion of that. The cash that they get from that obviously would go into their coffers to do other things, for example a buyback of shares, which we think would be justified, or a special dividend, and that's helped to buoy the price. The result's very good. They've grown their profits, and they've grown their profits because of the continued trend away from newspapers to online advertising of jobs. And I think that's got a fair way to go yet. It hasn't finished. And a lot of analysts were bearish on the stock or on this space because they felt that it had had its run in terms of that trend, that migration of advertising from paper to online. And also, we've got, you know, unemployment in Australia. Unemployment was stubbornly high in Australia. We heard people losing their jobs in retail, people losing their jobs in manufacturing, and people were losing their jobs in the financial services sector. So of course, all of us, we're all in the financial service sector, and we hear people are losing jobs, so we think, oh, you don't want to buy Seek. But its results prove otherwise. It's a fantastic one, and we like it.
Excellent. Good story. Good. Sorry about that, guys. We've run out of time. We had a few more, but we'll get to them next Wednesday, hopefully. That's all we've got time for today. So thank you so much to our guests, Roger Montgomery of rogermontgomery.com.